Welcome back to another lesson at AllGen Academy. So we've been discussing different concepts when it comes to portfolio management and construction, and today we want to discuss a third concept, which is dollar cost averaging. So we've talked about diversification and rebalancing, and today a strategy or a way of investing that a lot of people somewhat know about but don't really get the impact of it is called dollar cost averaging. Let's jump right in. Jason, let's define dollar cost averaging.
Yeah, so simply stated, dollar cost averaging is contributing an equal dollar amount periodically over time. But what it does is it tends to buy more shares with that equal dollar amount, buys more shares when the price of what you're buying goes down, and it buys less shares when it goes up. So let's look at that from a simple example.
Okay.
So let's say, for example, that you're going to start investing $100 a month, okay, into a mutual fund. We're going to call it XYZ mutual fund at the first of every month. Let's say you do that for 3 months, okay? So you can see here in the picture, you purchase your first purchase of $100 at $10 a share buys you 10 shares.
Right.
Well, let's not hope you don't own such a volatile mutual fund, but in this example, your mutual fund falls 50%, is down at $5 a share. On month 2, because it's now at $5 a share and you're using the same amount of money, you actually can buy 20 shares with that same amount of money.
With that $100.
With that $100,
right.
It gets you 20 shares. And then let's say it has a really great month and it goes up to $20 a share, and on the beginning of the third month, well, at $20 a share, $100 only gets you 5 shares.
Right.
So let's start from the beginning to the end of month 3, okay? You can see that it started off at $10 a share. It ended off at $10 a share. But because over time you bought a total of 35 shares, you now have a value of $350. So you've invested $300, and now you have a value of $350 because you're buying more shares when it's down and you're buying less shares when it's up.
Very good. Very good. So it's like saying, I don't know what the market's going to do in any given time frame, but it doesn't matter.
It doesn't matter.
Okay, if I'm just buying it consistently, especially if I'm investing for the long term, right? So when it goes down, I'm going to buy some on sale.
Yeah.
When it goes up, I'll buy it at a depreciated price, but that means my other ones went up as well.
That's right.
And at the end of the day, that should prove to be a pretty good strategy if you didn't have a lump sum to invest initially. Is that right?
That's exactly right. And the interesting thing about it is you almost kind of, in this particular example, in dollar cost averaging in general, the volatility of the market can kind of help you out to a certain degree if you keep that periodic investing over time.
That's right.
Which is a key. Keep doing it.
So give us a real life example of this.
Yeah, so here's a real life example. So we're looking here at the S&P 500, okay, and on the left side here, we're basically looking at what the S&P 500 did that entire time, okay, from the start of 2000, from right around 2000, 2011. This is what the S&P 500 did during that time. It took a big drop in 2000, 2002, rallied back up, then the financial crisis in 2008, but from point to point over that 11-year period, it actually had a slightly negative return, but basically a flat return. Okay. Now, if you took $100,000 and you divided that by the total number of months for that entire period, okay, that 11-year period, and you invested an equal dollar amount over that entire time, so that you've invested a total of $100,000 by the end of that 11-year period, even though the market was flat during that whole time, it went up and down a lot, but from point to point it was flat, you ended up with $119,000. So you invested a little bit over $100,000, basically $100,000 over that entire time. You averaged a return of 3.16%, even though the market was basically flat or slightly negative. So that just shows you the power of dollar cost averaging over time, in that even though the market's flat, you ended up having a decent return because you're buying more shares when the market goes down and you're buying less shares when the market goes up.
That's right. So there's pros and cons to both of these. Is that right?
There really is. And so, basically if you take dollar cost averaging versus just investing a lump sum of money up front, dollar cost averaging doesn't always work better. If you're in a really strong market, you're better off investing just everything up front, and the market would tend to do better. So dollar cost averaging works well in a kind of a flat to weak market, it can help protect you. But what I just want to be clear here, we're not advocating if you have a sum of money that you want to invest. We're not saying that you may want to consider dollar cost averaging in the market. We're talking about more from the standpoint of the benefits of dollar cost averaging when you're saving your money every month.
Right.
Okay, you're doing your budget, you're saving your money every month, and you're consistently disciplined, putting money away every single month, whether that be your 401k or you're doing it in like a Roth IRA.
Right.
And so that consistent periodic investment is a great way to build wealth.
Yeah,
over
actually,
time.
there was a study that showed a couple of finance professors did years ago that showed historically which came out better, given real returns in the markets and the bonds and all that kind of stuff. And they showed that historically, if you had a lump sum up front invested over the long term, you ended up doing better than if you just piecemealed it into the market.
Yeah.
Because while in the short term, dollar cost averaging seems to make sense, especially in the volatile market, the market historically has done this, so it's gone up. So it's been a strong market historically, better than any other asset class. So it made sense to always 100% of scenarios that they ran to invest lump sum over the long term over dollar cost averaging. But there are some vehicles, some ways that people don't have the lump sum that they can dollar cost average, and that still makes a lot of investment sense for them, right?
It really does. And like we're saying, those two great examples are like a 401k or a Roth IRA or even just just a regular brokerage account.
Right.
But it's essentially, just being disciplined of continuously putting money away every single month, even and especially if the market goes down, because that's where you get the biggest benefit of dollar cost averaging. So a mistake a lot of people make in their 401ks or the Roth IRAs, when the market goes down and they stop contributing and they don't put any money in, and that's where you get the biggest bang for your buck when you're dollar cost averaging, is you want to make sure you're putting the money in and continue to do that, especially when the market goes down, because remember, you're buying more shares when the price goes lower.
Right.
So that's where you get that's where it makes the biggest difference.
Yeah, in essence, it's on sale at that point.
That's right.
Who was it that said the stock market is Warren Buffett, the only place where things go on sale and people walk out the store or run out the store, run out the exit, run for the exits. It's counter logical in terms when you think about it. When things go down, buy low. Okay, but if you don't have that emotional or research ability, you're not watching it, then systematic dollar cost averaging is a way to get you over, stop yourself from defeating yourself.
That's right. And really another practical way to do that, if it, 3 or 401k is one example, that's an easy one. But a lot of times what you can do, like with a Roth IRA or just a regular investment account, is you can set up, just an automatic transfer from your checking account.
Monthly bank draft.
It's just a monthly bank draft, and we highly recommend doing that. A lot of people have good intentions of contributing to an investment account over time, but they let the emotions of the stock market and the news control that. But if you set an automatic, every $500, let's say, every single month, and you commit to that, and it's automatically being pulled, you learn to kind of budget and live off of what's left, and you consistently keep doing that over time, and that tends to do really well for the people who stick with it.
That's right. So at the end of the day, dollar cost averaging is a simple yet effective way to build wealth over time through consistent periodic contributions to your investment accounts. So thanks again for watching. We look forward to seeing you at the next lesson.